if there really is this market frenzy for AI companies, despite weak equity markets, you'd think these sort of mature companies are going to be the ones that maybe break into profitability, maybe end up IPOing, could give a return here. And you're paying at least 50% of their model, whereas NVIDIA, you're paying kind of 20, 30 times sales. I think if you really want to play the theme, this actually came to my attention as being potentially a reasonable play. Hello, and welcome to the Value Trap podcast, the podcast where private investors, Bruce Packard and myself, Mark Simpson, discuss the UK share market. Today, we're covering the latest investing buzzword, AI, artificial intelligence. We talk about both of us attending Mello recently, where Bruce saw Lord Lee presenting and I presented Paypoint on the Bash. We also get into a few details about recent news from Frontier Developments and DX Group. If you like this type of content, please subscribe and leave us a comment.
So NVIDIA is up 250% since November. NASDAQ's in a bull market, but AIM is flat. And a lot of that seems to be driven by general excitement about artificial intelligence. So I thought we could have quite an interesting discussion on AI and investing and what the applications for this actually are.
Yes, it seems to be the topic du jour, as it were, doesn't it? And the market gets these sort of fads. AI's been around for a while, but something captures the zeitgeist. Suddenly everybody wants to be on that bandwagon or of utilizing that technology. But like all these things, the effect will be far slower and take a lot longer to positively impact society and market returns, I think, than the market prices at the moment. Certainly for something like NVIDIA are 20, 30 times sales, something like that, I think.
Bonkers valuation.
Yeah, and even if it is the best chips out there, the incentive for other companies to catch up to optimize their chips for AI, like they all did for crypto. Crypto mining was the original big push why everybody wanted NVIDIA chips. It was their GPUs that could be effectively used, and now it's a different story. And yes, they'll do okay from it, and I think they had some really good quarterly results. But to generate returns on a 30 times sales, the growth rates have to be phenomenal, and they have to be over a very long period of time, and they can't be too capital intensive as well, because if all those returns are being invested back into chip designs and chip manufacturing, shareholders rarely see those returns and they end up with a sort of cyclical business. What do you think?
Yeah, so I was discussing this with a friend. She's an electrical engineer, but she's actually a programmer, or she's been a programmer for the last 15 years. And she has been looking into the applications of this. So she's not coming up with these very clever models, but she's trying to figure out applications which these can actually be useful for. And I talked to her about wealth management because Hargreaves Lansdown, for example, are spending 225 million of strategic investment costs on AI. I think some of this is just a systems upgrade anyway. But to put that into context, sales were just under 600 million for Hargreaves Lansdown. So they're spending a lot of money on. And I was just thinking about this in terms of wealth management, that I'm not sure that they really understand their customers or wealth managers. If they think a wealth manager can be replaced by AI, I'm not sure that's actually what a wealth manager does. It's what Rory Sutherland calls the hotel doorman fallacy. A management consultant can come along and say, oh, you can cut costs by replacing your hotel doorman. But actually, the hotel doorman isn't there to open the door. They're there because you can ask him directions, he can order you a taxi, he can discourage vagrants. And really, he's a signal that the hotel takes service very seriously. And if they've paid a man to put on a uniform and stand outside, then that's a very big signal that inside they take service very seriously too. So I feel like wealth management, it's not actually about advice. It's about, say, for instance, a 70-year-old widow and her husband dies who's been managing the financial affairs. And she just wants to speak to a personable, confident, competent young person to make her feel confident in her own decisions and know that she's not going to be put into anything too speculative. I can't really see that AI is going to change that.
Yeah, I agree on that one. I think almost like the job of a wealth manager is to try and guard you from your own worst instincts. for buying the latest hot fund, all of those things. I'm not sure they always do a great job in that. They can fall for the investing in the hot fund as well. But in general, you're paying them to be your better part in terms of market performance. And having an AI bot doesn't achieve that. I think maybe some of the back end stuff, maybe responding to complaints or things like that. I think we've talked in the past that some of that back end stuff potentially could be helped by AI bots. But you're right. I think the actual wealth management side is a people business.
We won't talk about Hargreaves Lansdown again because we talked about them a couple of months ago. But you were at Mello and you saw an AI Forward Partners. Presentation.
Yeah, so I only caught it because a friend said, "Oh no, actually, this is quite interesting." So it's a fund, effectively. It's a venture capital fund, and it says it specializes in supporting high growth, early stage technology businesses. And it's got roughly kind of 50 investee companies. It actually focuses quite a bit on AI companies, but it's not one that's jumped into AI in the last kind of few months. It's a company that has got investments over the last kind of 3 to 4 years in the AI space. I think it's currently on a kind of 50% of tangible book value. Now, that book value is mark to market. These are all early stage companies. Their book value was down from about 140 million in 2021 to 96 million, 97 million for 2022. So they've already taken a third off. I think they said due to some down rounds, you have these rounds where companies raise money. And if the next time they raise money is a lower value, everybody has to really mark down the value of their holdings. Even if they paid more for their proportion of the investment previously, they have to mark it down. So I think they've had a down rounds, but also they've been more cautious with the type of market we have. But if there really is this market frenzy for AI companies, despite weak equity markets, you'd think these sort of mature companies are going to be the ones that maybe break into profitability, maybe end up IPOing, could give a return here. And you're paying at least 50% of their model, whereas NVIDIA, you're paying kind of 20, 30 times sales. I think if you really want to play the theme, this actually came to my attention as being potentially a reasonable play. Couple of concerns I had when I saw them. The first was that the management saying, "Oh, we've got sort of 44p of value and that's growing 144%. And what they meant was these kind of 5 biggest companies are 44p of our NAV. Their sales in these companies are growing 144%. And you're like, that doesn't mean that the valuation itself is growing at that speed. There's a little bit of semantics. And the other one is, I think the CEO had some cash in this fund, but it wasn't serious money for somebody who's been in the technology VCT space for a while. So you wonder, is he really backing this as his number one place to generate returns?
Or is he just treating it as a paycheck? Yes. I think a lot of these things will be what I call Hollywood economics, which is there'll be 1 or 2 hits and then most things will lose money. And hopefully the hits are huge blockbusters, which make up for all the other things that haven't been as successful. It probably sounds like that with artificial intelligence and that fund as well.
Yeah, and potentially the other thing is because they've been in the space early, they have the relationships, so they will get foot in the door if AI really is the next thing. And we're going to see lots of companies that are going to change the world using AI. Potentially these guys have the contacts to get in there and assess them in a way that I wouldn't. There's no way I'm going to be able to tell, certainly at VCT valuations, whether something is worth investing in from an AI point of view. Every company is now just saying, "Oh, we're going to be a beneficiary of AI because we have this technology." And I have no idea whether any of these old school companies that are now claiming AI was always part of their plan are going to be a success or not from that side of the business. So I tend to leave those things.
It reminds me a little bit. I had a look at Hydrogen One, which was a Jim Ratcliffe, who was going to buy Manchester United or may still buy Manchester United, has launched a hydrogen fund or about 100 million, which again trades on a big discount to NAV. And I think AI, hydrogen, all of these quite speculative things, it's worth being a little bit cautious of, even with a fund, because the fund might be diversified into 20 hydrogen stocks or 20 AI stocks, but it's not going to be diversified in the way that the FTSE or even the S&P would be.
Yeah, wise words. So you made it over to Mello. First time for a while. What did you think?
Yeah, that's the first time I have attended the full event in person, and I really enjoyed it. And I really liked the ability to look management in the eye, see how they're presenting, see if they're ignoring any questions, because online, you can't always tell if questions are being glossed over. I did hear that David struggled to get companies to come out and present physically. And I wondered, partly that might be the pandemic, but partly I wonder if we're in particularly uncertain times, and a company like Wallpaint that is prepared to go out and face investors and tell a good story, they must have really strong momentum. And we saw this morning, actually, Wallpaint Q2 is going particularly well as well. They're going to be significantly ahead of expectations for the full year. I think it might just be worth keeping an eye on the list of companies that presented and just seeing how they do over the next 6 or 12 months. I'm expecting good things from them.
Yeah, there's possibly two types of companies. There's a company that's certainly a bit too early stage for me and is promotional because they need to raise money at some point. And you're right. I think the more mature company that's willing to come out, certainly in the current market, could be doing very well and doing better than expectations because they're quite willing to come and answer the questions, and sometimes with quite a poor share price and risking shareholders that are not entirely happy with the share price, even if the business performs.
Always a bit awkward to present, telling the bull case and things gradually deteriorate. And then over the next couple of months, you have to issue a profit warning. But yeah, having said that, you actually presented there as well.
Yeah, I did a presentation which was about can you time the market? So I looked at some of the indicators, and of course, the average investor has terrible market timing instincts. But I think there's a few ways you can be counter-cyclical. So the first is looking at the percentage that people have in equity funds. I think it's above something like 50% of investors' wealth is in equity funds. That's really bearish for the market. And if, maybe sort of less than 30-25% of investors' assets are in equity funds, then
a contrarian indicator, like the front cover of The Economist.
And yes, a guy called Lewis Robinson, who's a family office manager, he tweeted out an interesting chart which was comparing the fund flows into equity markets versus the forward 2-year returns or expected returns of, I think it was AIM and small caps combined. And it was something like when you see massive outflows from equity funds, the expected return, the forward return, is actually very good. And when you see really high flows to equity funds, the returns, the forward returns are actually very poor. Yeah, interestingly, UK equity fund flows have been pretty negative over the last 12 months.
So that is actually good news. Expected returns ought to be attractive.
Yes. Yeah. Whereas I believe the US side is less attractive because the S&P is doing quite well. Almost everybody in the US has an S&P tracker, and the percentage of people's assets in equity funds is quite high. Yeah. No guarantees with these things, but that was my takeaway, was that the outlook for the S&P, certainly over the next kind of 5 to 10 years, is not particularly great, whereas the outlook for UK small caps could be reasonable.
I actually listened to a Steve Clapham presentation, and he gave a talk about how expected returns for the S&P would be very low. And I actually felt, well, yeah, but if you don't have FTSE All-Share Index tracker, this would not be news for you, that the US market seems to have done particularly well, whereas the UK hasn't, and even Japan hasn't as well. I sometimes feel that we can become a little bit, or we in the UK can become very US-centric. And actually, there are lots of other markets out there. And to be financial writing, a lot of financial news is very US-dominated.
Yeah, I always enjoy the talks from fund managers or other investors more than the company presentations, because, like you say, you potentially get the company presentation online. It's not as great as looking them in the face and asking the question, but you don't often get some of these fund managers do online talks. So did you see anybody you were particularly impressed?
Lord Lee, listening to what he's got to say, and he started with the insight that you make most of your money in a bear market. You just don't know it for a couple of years. That's my experience. If you could buy in the first quarter of 2009, you didn't really need to be able to do any stock picking. There were a lot of outflows from hedge funds getting redemptions. And so there was a lot of forced selling. Assuming that we weren't going back to the 1930s, there was a lot of stuff to buy. And also I lost my job. So that was also my indicator to fill in my boots.
Your own personal conflict indicator, yeah.
So you can do market timing. You just have to wait till I lose my job.
Yeah, I think Lord Lee tends to invest in quite a lot of dividend stocks as well. So often those kind of bear markets, having that cash come in to reinvest. I've talked about before, I'm not a great fan of dividend investing. It seems to underperform value investing and something like dividend growth investing. The idea that you buy stocks on low dividend now because you think they'll grow dividend quickly. You know, you look at the data and it underperforms pure dividend investing. So if you're going to be in a dividend investor, forget dividend growth, just buy the cheapest, highest yielding stocks. Even then, if you apply a value on top of that, you can get a very good return from your dividends and the capital return of something that's cheap and is going to hopefully bounce back as well. And one of the stocks that Lord Lee owned recently, I think, was Appreciate, and that was taken over by Paypoint. So my tenuous link is Paypoint was my bash pick at the recent Mello. The takeover, I think, was part of the reason that Paypoint looked so cheap. They paid mostly cash. I think it was maybe something like a 40 something pence offer, of which 33p was in cash and the rest was in Paypoint shares. So Appreciate shareholders,
million, I think.
Right? Yeah, Appreciate shareholders got mostly cash and a small amount of Paypoint. All the kind of psychology says they probably didn't want Paypoint shares, and small amounts just get sold. Somebody like wants a holiday or wants something, they just, oh yeah, I've got these random shares I'll just sell them. So the price had been really weak on Paypoint. And even, I think, if I'm right, Lord Lee was selling before the takeover was completed, maybe for tax reasons, because I don't think it wasn't one that he had in a tax sheltered account. So, you know, you got this selling. ARB funds got involved. So I think he sold some arbitrage funds, took some of his stock, but then they shorted Paypoint to complete the arbitrage on the takeover. So you had funds shorting, small investors selling, and maybe some weak outlook in the energy sector because Paypoint do these Paypoint terminals that a lot of people use for prepay meters. Just looked too cheap to me, and it kept going down after my presentation as usual, but it seems to have bounced a bit. Have you looked at it at all? What's your thoughts?
Financials look amazing. 30% EBIT margin, 36% return on capital for a demographic of households that are probably suffering most from this cost of living, food, energy prices. And so that's made me a little bit nervous. And that probably explains why it's on a low multiple of, I think, 10, 11 times, low double-digit multiple. And so I just wondered about that.
I think in the short term, they've done okay because they tend to be the processor of a lot of energy payments. People who received energy payments via their prepay meter actually got vouchers and things that were processed through Paypoint. Paypoint were the administrator of this kind of business. If we think that the government support in that area is now ended, then I think they could see some weakness from now on. But in the short term, that wasn't a big issue for them. I think the reason they brought Appreciate was for the shopping side. They have these vouchers. Love to Shop, I think, is the one they bought from Appreciate. And it's the sort of thing you get from your employer at Christmas. I believe there's a tax exemption.
You give vouchers rather than cash, then it's
yes.
not a taxable.
Yeah, so I think it's about up to 50 quid or something like that. You can give 50 quid to your employees, and there's an exemption where they don't have to pay any tax on the amount. And it's obviously, if you want to incentivize your employees, it's a nice way of giving them a little bonus and making them feel nice about the employer. So as long as that tax exemption isn't closed, there will always be a market for these sort of vouchers. And also, even now, potentially people still don't want to give cash to relatives. It still feels a bit mercenary to be like, happy birthday, here's a £20 note. It's like giving somebody a voucher, but something that's can be used almost anywhere, somehow still a better thing to do. I think that's what Paypoint wanted really from Appreciate, was that side
and
of it.
This is one you own yourself?
Yeah, buying when I talked about it in Mello, but and then bought a bit more since then. It's bounced a little bit, so it's about one of the only stocks that's done well in the last month or so for me.
You also picked up on something on Lord Lee's speech about stop losses, that you feel like he might have changed his attitude towards stop losses.
Yeah, this was a pivot he had a couple of years ago, I think. He started to think that stop losses would add value to his process. But since then, it's been quite a severe market. And I didn't catch his presentation this time, but I did the previous Mello, so 6 months previous to that. I think he said from memory that he doesn't apply them in a bear market, when you have a bear market, you just get stopped out on things that are when the fundamentals haven't changed. And I do wonder whether this is like we say before, it's very hard to time the market and you need these contraindicators. But I do wonder whether if your contraindicator is flashing that this is a danger market, then that's the time to have stop losses. Whereas when everything's cheap at the moment and potentially the forward returns are very high, but anybody could fall 20% on no news at the moment, maybe now's not the time to have stop losses. What's your thoughts on?
That's a very good idea, that actually, rather than always use stop losses, never use stop losses, actually in a very frothy, very positive market where everyone's getting carried away, then stop losses are probably valuable. And I'm sitting on quite a lot of cash, so I don't really want any more cash, particularly from something that's maybe fallen 30% already. So I'm not using stop losses at the moment. I'm buying into a falling market when I see things falling and keep falling, particularly if they're net cash. I will continue to buy. What are your thoughts on stop losses?
I've never been a big fan of stop losses. It's never fitted my personality and my sort of investment style. It's never really fitted with me, but I am aware that I have the same biases as everybody else, is that I was positive about the market in the middle of 2021 when lots of things were going up and it looked like there's this bounce back from COVID, things are doing well. You want to be long the market, and those returns just felt like they were the normal bounce back of companies. Fast forward 18 months, and it was clear that a lot of them were overvalued, or a lot of them were trading on pull forward revenue from pandemic recovery and have not done particularly well. Not a fan myself, but I do see the attraction in certain markets, that sort of frothy market. Hopefully I'll be a bit better at spotting the next frothy market rather than just think I'm an investing genius.
I was more bearish. I didn't realize it was going to fall so hard, but I did write something about comparing the market to when Michael Lewis's Mexican strawberry picker in 2006, who was earning $20,000 a year, could afford a $600,000 mansion in Nevada somewhere. And I felt like the $100 million deli that Einkorn discovered, maybe that was the equivalent of the Mexican strawberry picker. And actually, in retrospect, I think that was probably right. I did sell a few things. I just didn't sell enough. I probably should have sold everything. And more recently, I've been buying Frontier Development after their various profit warnings. That just seemed to be oversold. And again, net cash now trading less than 2 times sales. And 72% of those sales are actually computer games prior year titles. So they've got this back book of revenue, and it's going to be loss-making this year. It's going to be loss-making next year. But computer games are a Hollywood economics business. A lot of computer games lose money, more than most lose money, but the blockbusters should be big enough to more than pay for the losses. If you look at Frontier Development over the last 10 years, their revenue's up 9 times. But within that, they've had 3 or 4 years where revenue's gone backwards. So it's never smooth. It's always volatile. And I just felt, will this be a better company in 3 years' time, 4 years' time? Yeah, I'm prepared to take that risk.
That seems a little brave to me. I read the recent trading statement, and as you say, loss-making this year and potentially then guiding loss-making next year, which I don't think was in the forecast, certainly not the forecast I'm seeing, although I've not seen the individual brokers' notes.
It was quite interesting wording. When they talked about the loss for next year, they claimed it was in the consensus, but the share price reaction down 10% rather implied that it wasn't. There's been a trend quite recently of brokers saying very upbeat things in their outlook statements and then saying negative things to their brokers. The most recent one I can think of, don't really want to draw attention to any particular company, but SDI did something quite similar to this, but also Oxford Metrics ahead of expectations for 2023, but then you look at Progressive's research forecasts and there's no upgrade to their 2024 numbers. So I feel like there's this little game going on of, yes, we say upbeat things in the outlook statement and then quietly say to our brokers, don't raise numbers, or please cut your numbers.
Or even, cut the numbers, and you see those forecasts going down. It's,
And people is another one. ETP is another one. But significantly ahead on the revenue, but the profit margin got hit. And I just feel like maybe the financial PR, or I don't know if this is the management or the financial PR, is being a little bit clever, because to be honest, I don't think anyone's fooled by if your profit margin halves, but your revenue's ahead of expectations. I don't think people are particularly impressed by that.
I do think investors miss the idea that you give a vague but positive outlook statement, but get your brokers to cut the numbers, because a lot of investors don't see those broker numbers immediately, or it takes time to work through to various kind of systems and aggregators. And sometimes you get stale forecasts where company cuts or changes broker and you get the old forecast in there. I think Argentex was the one that stood out to me, that the numbers in a lot of systems were still the previous broker numbers, and that they'd actually got the new broker to halve the numbers so that they could then beat them. So I think investors do miss that stuff. Sadly, it does work for companies.
Perhaps something that the regulators should look at then, that you have this weird system of companies saying vague things, then saying much more detailed things to the brokers. I used to be a broker. I know exactly how it's worked. And funnily enough, it's actually the smaller companies that tend to play this game. The larger companies, because they also, quite often they might have an ADR or a listing in the US, have to be much more careful about selective disclosure of what they say to who. And they might not put a point forecast saying, we expect to make 100p of earnings in 2024 in their outlook statement. But what they will do is say mid-single digit revenue growth, high single digit cost growth, these exceptional items that will be there. And so actually with a very simple 30-second back of the envelope calculation, you can generate your own forecast from that, and you don't need a broker. Yeah, perhaps something that the regulators should look at.
The average UK investor likes statements that just say, oh, ahead of expectations or significantly ahead of expectations. And we buy the stocks that just keep saying ahead of expectations, even if the broker's walked down those expectations. One of my biggest holdings is Capital Limited, formerly Capital Drilling. And they follow more this American international model of they give a revenue guidance and then they let the brokers do their forecasts and come up with numbers, and the brokers are continuously updating the figures. And sometimes it means that the company beats those expectations. Sometimes it means the brokers have missed things and have to adjust. But the company gives revenue guidance, and the last couple of years has been increasing and beating those revenue guidance. But the market tends to ignore that, because they didn't say significantly ahead, or that there wasn't this thing of a much more gradual increase of broker or decrease in broker depending on how they're trading or where things are. Yeah, somehow that doesn't seem to move UK investors quite the same way as maybe it would US investors.
The other thing that's probably worth considering is when you look at a company and whether it's beating expectations, is how much visibility management actually have over their revenue. And I would argue for a company like Capital, they rent out machinery, it's got to be shipped across Africa, probably having conversations with mining companies, and they probably have quite a lot of revenue visibility over the next 12 months. Argentex, that does foreign exchange trading, and even Frontier Development, computer games, which is very hit or miss. I feel like actually, even if the brokers' forecasts were very clear, even if the company put, this is what we think our revenue will be, I just think the nature of foreign exchange trading, and suddenly there's a lot of volatility and they make a lot of money. And it's not because they're taking proprietary risk and punting their book about, it's because suddenly all the customers go, oh my God, everything's going a lot more volatile. We need to hedge our position. I just think generally you need to also consider what the company does and how much visibility management really have over those forecasts, and how responsible they are as well for delivering them, because we can laugh at Argentex and managing down their forecasts by changing their broker. But really what that says to me is I look at the other FX traders, Alpha and Equals, both of those have had a similar thing where they thought they could draw a straight line extrapolating into the future and then realize that there was some disappointment or market conditions were much harder.
Yes, that's a good point. The other thing that stood out to me from Frontier Development, I didn't realize that I was reading it through and they said, oh, we've got adjusted EBITDA loss for the period and that we were expecting an operating profit. And I was like, how does that happen? Because normally it's the other way around. You can put what you want into adjusted EBITDA.
Number.
Yeah, but supposedly somebody pointed this out, was their adjusted EBITDA, they take off the capitalized development expenses to give their adjusted EBITDA. And it obviously it's good because it's a more conservative way of doing things. But it did remind me that There's no GAAP definition or IFRS definition of adjusted EBITDA, is there? Everybody can do whatever they want with their own figure.
We should just probably tease that out a little bit. Computer games companies, because software is the product, they are allowed to capitalize that cost on their balance sheet and then amortize it over the life of the computer game, which might be, I don't know, I'm imagining 4 years, 5 years, maybe shorter, 3 years. Any other company would have to expense through the P&L their software, their computer programmers' costs, because software is actually only being used internally, so the accountants don't know how to value it. Just in terms of the cash flow statement, if you look at the Frontier Development cash flow statement, they spent 36 million on intangible assets. Cash flow from operations was 37 million. So they were generating 37 million from people buying their games, but they were also spending 36 million to develop those games. On the balance sheet, there's 79 million of intangible assets that will gradually, over the course of the year, that will be amortized down through the P&L. Presumably that number on the balance sheet won't go down because they will continue to make new games, which will be capitalized on the balance sheet. So it's just conceptually a little bit different from other companies. There's no fraud going on, but it's just worth knowing that the EBITDA number with Frontier Development, as you just pointed out, EBITDA number does include the software costs that have been capitalized. That's a closer number to, how can I put it? It's a closer number to cash than other companies' adjusted EBITDA number.
Yes, that's a good way of describing it. It really could be considered maybe a form of underlying cash flow minus their taxes and their interests, whereas for other companies, it clearly isn't. Yeah. It can go both ways in terms of you can get companies that expense everything, therefore you get a benefit or you get a potential future benefit. I'm thinking of kind of Somero that do quite a lot of innovation, but they expense all the costs of that innovation. Obviously, you need those innovations to actually sell and be a reasonable product. But then what it does do is it flatters the return on capital, because if all that money spent on developing products isn't going onto the balance sheet, there's a much better return on capital. But also there might be a lot of hidden value in terms of future business that's, the money's been spent to develop the future business. So with all of these things, there's no substitute for getting down into the details of what the business does, is there?
Yeah, this was the argument with Coca-Cola. Coca-Cola has an artificially high return on capital because actually the marketing expenses are expensed through the P&L, and they arguably you should add them. A different way of looking at it would be to capitalize them on the balance sheet. They're not allowed to do that by the accountants, but effectively the reason why Coca-Cola's return on capital is so high is the capital isn't really recorded because they're spending all this money building a brand and it's just expensed through the P&L as a cost. What else have you been looking at this week?
Again, doing something on Mello, which was the Mello Bash, and that was DX Group. I think everybody knows what it is. It's a specialist in bulky and weird-shaped freight. The news over the weekend was that Tufnells, that used to be owned by Smiths News, isn't anymore, was sold off, has gone into administration. So obviously, worrying times for employees and for drivers, potentially customers. The bulky freight, what they call one-man bulky freight deliveries, you've only really got 3 big players, each with about sort of 15% market share, and Tufnells was one of them. DX is the other. Off the top of my head, I can't remember what the third one is. It's in the one of the DX presentations if anybody wants to look it up. But taking sort of 15% of the market share out of the business. Now, I guess the administrators may try and sell Tufnells on as a going concern, but you'd think that a lot of the value is now leaving that business. A lot of the drivers are being hired by DX or other competitors. A lot of the customers are already opening accounts with DX or other competitors. Whether it will deliver a sustainable increase in revenue for DX, I don't know, but certainly in the short term and for customer relations and building new customer contacts and relationships, I think this is fairly positive news for DX. And it already looked quite cheap to me. It was a P of 7 or 8, and
it's cheap because of the history. I haven't looked at it for a while, but this was a private equity IPO in 2014 at 130p, and that was Arla Partners, who were later bought by someone else. It fell to 7p in 2017 after a couple of profit warnings. And they not only just did an IPO and then had a couple of profit warnings, they also wrote down about 170 million. Their shareholders' equity went from 182 million to 16 million 3 years later. So you do an IPO, you do a profit warning, and then you write off 170 million. And you can understand why the share price went down 95% in value. More recently, the auditors resigned, and there have been all sorts of accidents. And I can remember looking at this a few years ago and think so many things have gone wrong. This is either going bust or it's going to be a multi-bagger. And actually, it's been a multi-bagger. But I can see why it trades on a low valuation, given the history.
Yes, yeah, that is a good point. There's been a fair bit of history, and it was suspended for something like 9 months. It doesn't always appear in all these kind of stock charts. Some just edit that period out. But the allegation, I believe, was that some of the depot managers for DX were bribing depot managers or drivers from Tufnells. So whatever's gone on, it potentially the management just managed it badly in terms of not dealing with the root cause, not getting on top of it quickly, and this kind of spiraled into the auditors resigning, but then without an auditor, they couldn't get the accounts signed off, and they didn't say a lot publicly. I don't know whether they were legally bound by not revealing stuff, but then that doesn't help. An auditor's effectively lending their reputation to a company when they audit them, and therefore you're not going to get a lot of high quality auditors jumping at the chance. They just don't know what has gone on and what the concerns are. Eventually they did get an auditor, they did, relist and come back from suspension. I guess there's still those risks there. It seems like they've put a lot of this behind. They actually settled with Tufnells announced they settled with Tufnells on a claim against them on pretty much the day they went into admin. I don't know whether they settled a day too soon or whether Tufnells pushed for a very good settlement because they knew they needed the cash as soon as possible. You can read all sorts into that.
DX Group has done very well since that 7p low in 2017. Other than the history, the other thing that put me off a bit was the low margins. Just structurally, logistics groups, it's not a business with a particularly strong moat, I don't think.
Not the strongest of balance sheet, in my opinion, as well. I think just the current current account doesn't look, or the current ratio doesn't look amazing. And I think it's a business that can trade quite happily with a low current ratio, just the nature of the business. They're getting paid up front, and then they're paying their drivers, and they're probably paying their fuel on account and their drivers at the end of the month. So there's a bit of effectively negative working capital flow in that. But that doesn't give them a lot of capacity to deal with any downturn. So as long as they're still going and they're growing, then actually that sort of model will throw off cash. It's the only issue is only if you see a big downturn in trading. So I guess fingers crossed with Tufnells going, that's not going to be a short-term issue, but it's definitely one to watch. I think it is a pattern, isn't it, that these private equity IPOs tend to be ones to avoid.
Yeah, I've looked at Doc Martens a couple of weeks ago, and the private equity guys that sold that, they made 3 times their money. But if you bought in the IPO, you lost 2/3 of your money. I don't know why these professional fund managers buy IPOs, but caveat emptor, I think.
Yes, with DX, it was clear that DX part, the kind of document exchange that started off as the main cash cow, was solicitors wanting documents that would definitely be delivered by 9 a.m. the next day. And obviously they were willing to pay a premium for that. But that main part of that business has been really affected by just email being allowed to be accepted for legal documents in some cases and that kind of side of things. So, yeah, I would suggest that the private equity knew that the writing was on the wall on that, given how fast it unraveled and particularly how quickly the assets were written down. And with Doc Martens, you wonder whether the private equity kind of tend to be pretty good at knowing when the top is in terms of sales and margins and things like that. But then there are some that do well. I guess that's the dice that the fund managers are rolling. If they don't buy into any IPOs, they don't get the call when there's something that they really value. I think, yeah, I'd wait for that post-IPO. Those first few warnings and buy. I mean, that can be a very good strategy. Yeah. Wait for the first few warnings and buy at that point.
Well, that's it for another episode. If you like this type of conversation, then please subscribe. And don't forget to check out our partner episodes on Fund Your Retirement Podcast Network. The links are just below in the bio, along with our Twitter handles. See you for the next episode. Until then, bye for now.